As of Friday's close, spot silver is trading at $26.84 per ounce, down 3.7% on the session, and 11.2% below the recent swing high of $30.22 recorded 8 weeks ago. At the same time, price remains 18.5% above the $22.66 cyclical low established earlier in the year. That defines the current equilibrium, a corrective phase inside a broader recovery structure. The decline is not random, it is occurring into a delivery sensitive window where paper positioning and physical availability are diverging. The measurable anchor is the ratio between COMEX registered inventory and total open interest. Registered silver currently stands at 275.4 million ounces. Total open interest across all active contracts is 156,280 contracts. Each contract represents 5,000 ounces, equating to 781.4 million ounces of paper exposure. That places the paper to registered coverage ratio at 284 to 1 on a gross basis, meaning outstanding futures claims represent nearly 3 times the metal currently classified as deliverable. This ratio does not imply imminent default, but it does quantify leverage embedded in the system. Eligible inventory, which sits outside the registered category, cannot be assumed deliverable without owner consent. Therefore, delivery stress is assessed strictly against registered stocks. The recent price compression must be evaluated through this lens. Declining price during elevated leverage suggests liquidation pressure in paper markets rather than relief in physical tightness. This is not a volatility spike in isolation. It is a structural adjustment unfolding within a delivery cycle that is compressing into a measurable supply constraint. COMEX registered silver inventory is currently reported at 275.4 million ounces, while total eligible inventory stands at 468.7 million ounces, bringing total vault holdings to 744.1 million ounces. The distinction is critical. Only the 275.4 million ounces classified as registered are available for immediate delivery against futures contracts without requiring ownership transfer. Total open interest across all active silver contracts is 156 in the 280 contracts. At 5,000 ounces per contract, that represents 781.4 million ounces of paper exposure. Dividing 781.4 million ounces by 275.4 million ounces produces a paper to registered ratio of 2.84 to 1. In practical terms, if every open contract demanded delivery simultaneously, registered inventory would cover only 35% of obligations. The front month currently transitioning toward delivery is the March contract. First notice day is February 28th. As of this morning, March open interest remains at 38,920 contracts, equivalent to 194.6 million ounces. That single contract month represents 70.6% of registered inventory. This is the compression point. Delivery mechanics operate through a notice process. Shorts issue delivery notices to the clearinghouse, which assigns them to longs holding contracts beyond first notice day. Longs who do not wish to take delivery typically roll forward into the next active month before first notice. The roll period is therefore decisive. If open interest declines aggressively, pressure dissipates. If it remains elevated, shorts must source metal or negotiate alternative settlement structures. Cash settlement remains legally permissible, but it introduces reputational and pricing risk if conducted at scale. Historically, large delivery months have seen accelerated inventory reclassification from eligible to registered as vault owners make metal available. That conversion is voluntary and sensitive to price. If price weakness discourages conversion, the leverage ratio tightens further. The next 10 trading sessions determine whether this decline reflects healthy position clearing or emerging delivery stress within a constrained registered pool. From a technical standpoint, silver is now trading below its 50-day moving average at $27.92 and marginally beneath the 100-day moving average at $27.10. The 200-day moving average remains lower at $25.48, defining the primary structural trend. The breakdown through $28.0 removed the first layer of support that had held during the prior consolidation. Immediate resistance is now established at $27.90 to $28.10, aligning with the 50-day average and the breakdown pivot. Secondary resistance sits at $29.75, just below the prior high of $30.22. On the downside, first technical support rests at $26.40, followed by a structural support zone between $25.50 and $25.70, directly overlapping the 200-day moving average. The technical compression becomes materially relevant when overlaid with delivery timing. The March contract approaches first notice day on February 28th. Historically, price volatility increases into the final 10 sessions before notice as longs either roll forward or prepare to stand for delivery. If price reclaims the 50-day moving average before first notice, it suggests that liquidation pressure is being absorbed and that commercial hedging activity is stabilizing the market. Conversely, sustained trade below $27.00 into notice increases the probability that speculative length exits rather than stands, reducing delivery strain but reinforcing short-term bearish momentum. The 14-day relative strength index has retreated to 42, down from 64 during the recent high. This shift reflects distribution rather than oversold exhaustion. Commitment of traders' positioning shows managed money net length declining by approximately 12,000 contracts over the past 2 reporting weeks. That reduction aligns with price weakness and suggests that hedge funds are reducing directional exposure ahead of delivery risk. However, if price holds above the 200-day moving average while March open interest remains elevated above 30,000 contracts into the final week before first notice, the technical structure intersects directly with delivery mechanics. In that configuration, downside technical pressure could coexist with tightening physical leverage. Such divergence historically produces abrupt repricing once weak hands exit and remaining longs demand metal. The next decisive signal is whether price can reclaim $27.90 while open interest declines in an orderly fashion, or whether price remains suppressed while delivery exposure stays concentrated. The structural backdrop is defined by a measurable physical deficit. According to the latest report from the Silver Institute, the global silver market recorded an annual deficit of 237.7 million ounces in the most recent reporting year. Total global demand reached approximately 1.24 billion ounces, while total supply was approximately 1.0 billion ounces. That gap represents one of the largest structural deficits on record and marks the third consecutive year in which consumption has exceeded newly available supply. Industrial demand remains the dominant driver. Fabrication for industrial applications totaled 654.4 million ounces, supported primarily by photovoltaic installations, automotive electrification, and semiconductor manufacturing. Solar demand alone exceeded 190 million ounces, reflecting record global capacity additions. Jewelry demand contributed 208.7 million ounces, silverware accounted for 54.2 million ounces, and physical investment demand added 263 million ounces despite price volatility. On the supply side, global mine production totaled approximately 820 million ounces, while recycling contributed 178 million ounces. Mine output growth has been constrained by declining ore grades in Mexico and Peru, permitting delays in Latin America and capital discipline among primary producers. Recycling flows have improved modestly but remain insufficient to close the structural gap. Regional import flows reinforce the imbalance. India imported approximately 5,200 metric tons of silver during the year, equivalent to roughly 167 million ounces, reflecting strong bar and industrial demand. China's net silver imports exceeded 3,400 metric tons, or about 109 million ounces, driven by industrial consumption and strategic stockpiling. Combined, these two markets absorbed a material share of globally traded physical supply. A deficit of 237.7 million ounces does not imply immediate exhaustion of above-ground stocks, but it requires drawdown from inventories accumulated during prior surplus years. Over 3 consecutive deficit years, cumulative drawdown exceeds 600 million ounces, This is the macro inventory drain occurring beneath short-term price fluctuations. When futures market leverage intersects with a multi-year physical deficit, the sustainability of registered inventory becomes the central analytical question. The silver delivery structure cannot be analyzed in isolation from capital flows within the sovereign debt complex. The latest U.S. Treasury data shows that Japan reduced its Treasury holdings to approximately $1.13 trillion, down from $1.17 trillion 6 months earlier. China's reported holdings declined to $775 billion compared with $835 billion a year prior. While the absolute levels remain substantial, the directional change signals gradual diversification away from concentrated dollar duration exposure. Foreign official holdings in aggregate have flattened despite persistent U.S. fiscal expansion. The U.S. federal debt now exceeds $34 trillion, with net interest expense projected above $1 trillion annually. The weighted average maturity of outstanding debt has shortened over the past 2 years as issuance shifted toward Treasury bills. This increases rollover sensitivity to short-term rate volatility. From a macro debt cycle perspective, elevated refinancing risk combined with structural deficits historically correlates with currency volatility and higher demand for tangible monetary assets. Capital rotation into commodities has been incremental but measurable. Central banks collectively added more than 1,000 metric tons of gold over the past year, reflecting reserve diversification behavior. While silver is not formally a reserve asset for central banks, it tends to track monetary metals sentiment during periods of currency uncertainty. The correlation between the US dollar index and silver remains inversely significant on a rolling 6-month basis. When real yields compress or fiscal credibility weakens, silver's monetary component reasserts itself alongside its industrial function. Global uncertainty metrics also remain elevated. Sovereign credit default swap spreads in several emerging markets have widened modestly, and geopolitical risk premiums are embedded in energy markets. These factors contribute to portfolio hedging flows. Institutional asset allocators facing duration risk often increase exposure to commodity baskets as a diversification mechanism. Silver benefits disproportionately during early stage rotations because of its smaller market capitalization relative to gold, amplifying marginal inflows. Historically, periods characterized by expanding sovereign debt burdens, declining foreign treasury participation, and rising fiscal interest expense have coincided with multi-year advances in precious metals. The present environment does not guarantee repricing, but it establishes macro conditions under which a structurally tight physical silver market can respond rapidly to shifts in currency confidence. Bullion bank exposure is primarily structured through delta-neutral hedging against producer forward sales, structured products, and ETF inventory facilitation. Commercial short positioning in COMEX data currently exceeds 70,000 contracts net, equivalent to 350 million ounces. A substantial portion of that exposure represents offsetting hedges rather than outright directional bets. However, hedge effectiveness depends on orderly roll behavior and sufficient liquidity in forward months. If front-month open interest remains elevated into first notice day, banks must either allocate registered metal source physical through OTC swaps or expand short exposure further out the curve. Hedge funds, categorized as managed money, currently hold approximately 42,000 contracts net long after recent liquidation. Implied volatility in at-the-money options has risen from 24% to 31% over the past 3 weeks, reflecting increased demand for downside protection. Volatility positioning matters because dealers who sell options hedge dynamically. As price declines, dealers may increase short futures exposure to maintain delta neutrality, reinforcing downward momentum in thin liquidity windows. ETF flows add another dimension. The largest physically backed silver ETF, iShares Silver Trust, currently holds approximately 425 million ounces. Over the past month, net outflows have totaled roughly 6.2 million ounces. ETF mechanics operate through authorized participants who create or redeem shares in exchange for physical metal baskets. When shares are redeemed, metal is released from the trust and can re-enter wholesale circulation. When shares are created, physical must be delivered into the trust, tightening available supply elsewhere. If delivery stress accelerates on COMEX while ETF inventories are simultaneously declining, the system may rely more heavily on OTC leasing markets. In that scenario, short-term lease rates typically rise as bullion banks compete for available bars. Elevated lease rates increase carrying costs for short positions and can steepen backwardation in near-dated spreads. Should March open interest remain above 30,000 contracts into final notice while registered inventory fails to expand meaningfully, bullion banks would need to convert eligible stocks or incentivize cash settlement. Neither outcome constitutes default, but both signal tightening conditions. The critical variable is whether hedge short exposure can be managed within existing inventory buffers without triggering elevated lease rates or accelerated ETF drawdowns. The bearish case rests on liquidation math and macro tightening persistence. If March open interest declines below 20,000 contracts before first notice day, equivalent to 100 million ounces, delivery exposure falls to 36% of registered inventory. In that scenario, leverage normalizes and the paper to physical ratio compresses naturally without stress. Simultaneously, if price fails to reclaim the 50-day moving average at $27.92 and instead breaks below $26.40 support, systematic funds may increase short exposure. A decisive weekly close beneath the 200-day moving average at $25.48 would likely trigger additional trend-following selling. Rising real yields above 2% on the U.S. 10-year Treasury would further pressure non-yielding assets. Under these conditions, ETF outflows could accelerate, releasing incremental physical supply into wholesale markets and easing near-term tightness. The bearish structure therefore assumes orderly roll behavior, continued macro dollar resilience, and declining managed money net length without delivery escalation. The bullish case relies on delivery concentration and cumulative deficit arithmetic. If March open interest remains above 30,000 contracts into the final 5 sessions before first notice, that represents 150 million ounces against 275.4 million ounces registered. Should even one-third of those contracts stand for delivery, 50 million ounces would be removed from registered stocks, reducing available coverage materially. Overlay this with a 237.7 million ounce annual structural deficit reported by the Silver Institute and 3 consecutive years of cumulative drawdown exceeding 600 million ounces. If ETF flows stabilize or reverse positive while industrial imports from India and China remain firm, incremental supply becomes constrained. A price reclaim of $27.90 concurrent with stable or rising open interest would indicate absorption rather than liquidation. In that configuration, technical resistance at $29.75 becomes vulnerable. The bullish framework depends on sustained physical demand intersecting with leverage futures exposure inside a tightening inventory channel. Both paths remain measurable within the next delivery window. The tactical window is defined by specific calendar and data checkpoints. First notice day for the March contract is February 28th. The final 5 trading sessions preceding that date will determine whether open interest compresses below 25,000 contracts or remains elevated above 30,000. A daily decline of more than 5,000 contracts would signal orderly rolling. Stability or increases during that window would indicate potential delivery intent. Price levels to monitor are precise. Immediate resistance remains $27.90 to $28.10. A daily close above that band shifts short-term momentum constructive. Secondary resistance sits at $29.75, with $30.22 representing the prior swing high. On the downside, $26.40 is first support. A break below that exposes the $25.50 to $25.70 zone aligned with the 200-day moving average. Registered inventory must be tracked daily. Any increase above 290 million ounces implies voluntary reclassification from eligible stocks and reduces stress probability. A decline below 260 million ounces into notice week would materially tighten coverage. Open interest relative to registered inventory should remain below a 2.5 to 1 ratio to avoid compression risk. Premium spreads between Shanghai and London markets are equally relevant. A sustained premium above $1.0 per ounce in Eastern markets relative to Western spot pricing would indicate regional tightness. Combined with rising lease rates or widening nearby calendar spreads, that would confirm tightening wholesale conditions. These metrics collectively define the near-term decision matrix. The current structure is defined by measurable leverage layered over a multi-year physical deficit. Registered inventory of 275.4 million ounces stands against total open interest representing 781.4 million ounces, producing a 2.84 to 1 coverage ratio. The March contract alone represents more than two-thirds of registered supply. At the same time, the global market has absorbed a 237.7 million ounce annual deficit, with cumulative drawdowns exceeding 600 million ounces over 3 years. This is not a narrative imbalance, it is arithmetic. If open interest compresses before first notice, pressure dissipates and the decline reflects positioning reset. If it remains concentrated while inventory fails to expand, delivery math tightens quickly. The timing window is therefore defined by the final sessions into February 28th. Price action alone is insufficient. Inventory movement and contract behavior will determine whether this episode resolves as liquidation or escalation.